Thank you, Kelly. I'm going to start it off and then turn it over to Michelle for the bulk of the presentation on the great work that she's doing. But I wanted to introduce with a little bit of context around auto finance and the business of mobility and this transition from products to services. So as we all know, about 15 years ago, Apple introduced the smartphone, the iPhone, and it began a revolution in turning products into services. And Uber and Amazon and DoorDash were an early result of that, but that's really just the tip of the iceberg. What's coming is with the introduction of Web3 and blockchain-based identities, is the rest of that revolution that's even bigger. And I want to give some context around that and explain why I think that's true and why I think the work that Michelle and others are doing is so important. So consider how people buy new cars. In the US and in the developed world, cars are generally financed. About 80% of new cars, maybe 90 in the US, are financed. And people don't buy them out of savings. They're expensive. And the way that they're financed is fairly unique relative to how other assets are financed. Other assets are financed based on their value or their ability to produce a cash flow. A car is financed based on somebody's lending score, right? In the US, it's a FICO score. In other places, it's a different reputation score. But basically, if you're wealthy enough to get a good score, you're old enough to have a credit record, then you can finance a vehicle. That's very different than sort of how trucks are financed, for example, where it's the ability of the truck to earn in commerce in a business that allows the financing of the truck, or commercial real estate, or business financing generally. That hasn't happened in autos because of a number of reasons. One is the collateral. The vehicle moves and is hard to secure, and also it's very difficult to attach the earnings from a vehicle. And then, of course, before these services like Uber and the smartphone revolution, vehicles weren't used in commerce. They were used really in personal transportation and couldn't earn. And so this smartphone revolution and this ability of vehicles to participate in commerce or to be part of a business model like Uber, decentralized business, it creates a new opportunity for how to finance personal mobility. Right now, somebody can buy a car, have it participate in commerce, or use it in a business, and use the earnings to finance the car. The problem is that business model, that financing model, really hasn't emerged yet, because there's a missing links between reputation and attaching the earnings from the vehicle and directing them toward the lender that still need to be solved, and that Web3 and blockchain bring important pieces of the solution for that. There's really two business models in there, and two things that need to be done. One is this fixing the reputation, filling the gaps in FICO, being able to use reputation and ongoing reputation and current reputation as part of that business model for lending. And the other is attaching the earnings of the vehicle. We have some companies, including Spring EV, as members of MOBI, who are doing that in the electric vehicle space, trying to use the lower operating cost of electric vehicles as part of the financing mechanism, in the way that solar panels are done with houses and power generation. And we have Michelle on the reputation side, and she's going to talk about that. So that's the larger context of what we're doing in MOBI. In MOBI, as most of you know, we had a working group on finance, smart contracts, and securitization that Michelle was active in. She was also active in our vehicle identity working group, and she's been an active MOBI member for many, many years now. Michelle has been extremely busy in addition to her work with MOBI. In the last 10 years, she started and built 8 companies simultaneously in the social impact space, doing good while making good. She's written a book on transportation, freedom of motion. She's a car person. She aspires to have a 1-bedroom house with an 8-car garage. Well, Michelle, I'll turn it over to you and let you talk about all the rest of the great work that you're doing. Thanks for joining us today.
Thank you, Chris. I love that. That's terrific. And thank you all for making time this morning. I know that many of you on the call have a really good understanding of blockchain. But if you'll bear with me a little bit on this, I know that there are also some folks on the call who don't. And so I'm going to talk a little bit about what blockchain is as we talk about how we see the opportunity for blockchain to be utilized in our business. And I'd like to start by thinking about really what blockchain is. And I know many people believe that this is something that is just brand new and radical idea. And I actually look at it a little bit differently. The idea for one of the key parts of blockchain is actually really old. It started in the Renaissance in Venice with a mathematician in 1494 named Luca Pacioli. And this was at the time of the printing press and the Gutenberg Bible. And Luca Pacioli wrote a book that was a bestseller in its day, widely read. And what he talked about was a system for figuring out how a business is performing. And it hadn't been done before. It was very radical. But what he proposed was the creation of a ledger. Double entry accounting. He basically said that if you are a merchant in Venice and you buy cloth with a gold coin, you need to account for both the cloth and the coin. You had to know the history of where something had been and where it was going in order to really understand your business. You had to record an entry twice. This is double entry accounting. And it was simple and balanced and elegant, and it laid the groundwork for the financial realm that we know today. And the idea behind having a ledger was to create a roadmap so that someone could look at it and understand what this business was really doing. And the idea behind that led to audits. And I would suspect that everyone on this call has been a part of an audit. If you have businesses, I have a lot of them, a lot of audits that I have to deal with on an annual basis. They're time consuming and expensive, but necessary because in our society, we rely on someone to be a single arbiter of truth. And we look to those auditors to tell us, yes, in fact, this is an honest representation of this business's activities. But we know that isn't always the case, that isn't always honest representation of what's going on. So we're going to spend the next 30, 45 minutes this morning talking about trust. And I think a good place to begin with that is Enron. Remember them, right? That little bitty company in Houston with the crooked E logo. Yeah, and their auditors, Arthur Andersen. And both of those companies are no longer around. And so we know that even though their audits presented a picture of what was going on, that it wasn't necessarily the actual truth. All of the financial system that we exist in relies on trust. That's 100% of what it's built on. And we can look back in time to instances all across our history of moments when there was too little trust in the system or too much trust, and what can happen. We think about the run on the bank in the 1920s and the impact of that. We think about Charles Ponzi and Bernie Madoff and the impact of too much trust. We think about what happened in the financial crisis in 2008 and a complete lack of awareness of what was really happening. Everything in the financial system relies on the confidence of the participants within it. And that is, in fact, what trust really is. blockchain has sometimes been called the truth machine. And I really love that way of thinking about it. And this is one of the unique aspects of blockchain that I think is fascinating for those of us who are engaged in it, in that rather than one central agency, a government, an auditor, someone saying, yes, in fact, this is the truth, blockchain utilizes truth by consensus. It is described as a distributed ledger technology, and hence it gets back to the idea pioneered by Luca Pacioli that we're keeping a ledger. But in the context of blockchain, we're all keeping the ledger, every one of us who is participating in this system, and we all collectively determine truth ourselves. So oftentimes when we talk about technology or concepts that we're unfamiliar with, it's helpful to look at analogies as a way of understanding it. And I don't think this is a perfect analogy, but it's been published, so I'll use it here. And I think it helps with the idea around consensus, and that is of Google Docs or Google Sheets. Instead of the way that some of us do things with Excel or Word, where we put together a document or spreadsheet and we send out for comments and we ask everybody to make their edits and we bring it back and we put it together and send it out and say, yes, this is what we all agreed to and this is what the final product is. With Google Docs or Google Sheets, we're all looking at it together at the same time. So we have the ability to track those changes and all work together. That is a more collaborative form. And that gets to the heart of one of the really key components of the consensus feature of blockchain that I think is really, really important. So many of you might say, well, Enron and Arthur Andersen and their attorneys and many others, that was a consortium and that was a group collaborating and putting out what they said was truth. Which gets us to another interesting feature, I think, of blockchain and really where it gets its name from. Every block on the chain includes the information that came before it, the transactions that preceded it. It's very much like human DNA. You go get your DNA test and you see all the generations, all of your ancestors that came before you. It's very difficult with blockchain, I'd say impossible really, for a bad actor to go in and try to manipulate something after the fact because of this really unique structure. Blockchain has this immutability, it has permanency and transparency that doesn't really exist in any other systems that are out there. So as Chris and Kelly mentioned, I have several businesses. On the Road Lending is one of them. We work together, all of our organizations, with a common mission to try to build prosperity for working families and bring down the costs across the transportation value chain. And the idea behind that, and then where it's relevant for blockchain, is that we can remove the middleman, reduce friction in these transactions, and bring down costs. So we have a Texas motor vehicle dealer that has a dealer's license. We have a nonprofit, as was mentioned, that helps primarily low to moderate income, credit invisible or credit weak consumers figure out how to buy a really good car. It's kind of akin to a mortgage, not a mortgage, but a realtor who helps you to try to find a house and kind of walks you through that process. We're a bit of an advocate for the consumer. We have a social purpose private equity fund that's a triple bottom line investment opportunity. We provide financial, social, and environmental returns there. And we use back-ended capital from impact investors to make low interest loans to consumers. We have On the Road Garage, which is a training and collision facility that's bringing down costs to maintain vehicles. So really the only part of the value chain that we're not in, and I don't think we ever will be, is insurance. I don't want to be a part of that. Other people can do that better than we can. So if we can take out some piece of the process in all of those parts of the value chain and bring down costs that we can pass on to a lower income consumer. And by the way, getting to Chris's point about the importance of mobility and the uniqueness of it, the car is more than just an opportunity to get from point A to point B. For our customers, we've had people who have tripled their income just as a function of being able to drive to another county to take a good job. It means getting better food. It means accessing better medical care. There are a lot of things that happen with the vehicle that are so unique to just about any other asset that a human being might own. So with our mission in mind, one of the first parts of our loan process, and really any loan process for any lender, is know your customer, KYC. All lenders have to comply with regulations around this. It's an anti-money laundering, anti-terrorism kind of effort. But for us, it really is about knowing your customer, because we don't rely on credit scores. We look at them because we want to establish a baseline, and we think they're instructive, and it gives us an opportunity in financial coaching to help our borrowers become better consumers, more financially knowledgeable. But we use character as the basis for extending a loan. And there are very few lenders out there that look at things this way. And this is part of why I think the idea for a reputation index on blockchain has some real relevance for the kind of work that we do. We get input from a group of people before we make a loan. Yes, this is not an efficient system. It's a very inefficient system, but part of that is by design. And we have to try to gain efficiencies wherever else we can, which is also why we're looking at blockchain. So we ask a landlord, is this person a good renter? We ask the employer, has this person been a good, responsible employee? We might get a recommendation from a partner agency that referred this family to us. We gather all of those pieces together. And in that sense, our work is extremely collaborative, which is the beauty of blockchain. It's a collaborative system. It's very much a system that works together with a larger group of people. The majority of lenders make decisions on loans internally within their four walls only, and utilizing credit scores almost universally. And one of the criticisms of credit scores that I will come back to in a minute is that the data is old. It's a lagging indicator. So someone may have dramatically improved their financial position in life, and it may not be reflected in that credit score. So the idea of building a digital representation of trust, that someone has an identity within blockchain that others can contribute to or go to and look at and say, yes, I see that this person has been considered to be a very trustworthy person by the indications within this system, I think has some tremendous power, particularly for credit invisible or credit weak consumers. I think there's been a little bit of experimentation done on this in some totally non-lending applications. And one of my colleagues, Dave Eddy, refers to this as the love token. And I like that. It's kind of a digital thumbs up or pat on the back that you can do. So once we've made the decision that we want to extend a loan to someone, we enter into the loan documentation phase. And there is suitability for blockchain here as well. Unlike a lot of lenders, this really surprises me that really large lenders still by and large use wet signatures, require a borrower to come and sit down in front of them and sign a document. We don't do that. Our borrowers are transportation challenged, and we're spread out all over the country, even though we're a small company. And so we do everything digitally, and we always have. But that requires that a loan document, which is a legal agreement and a secured interest represented by a loan document and a title to the car, that those documents are handled carefully and that there is a level of trust that those are authentic. So there's an opportunity there as well. One of the neat features of blockchain that is compatible system with blockchain is smart contracts. And I really see a lot of opportunity for us to use this and as a way of really saving a lot of time and money for us. One thing that we do that pretty much all lenders do is we have investors who are part of our team, impact investors and some banks that have put money into our loan fund for us to make these below market loans. And at every month, we download an analysis of our portfolio and we put together a waterfall distribution report that we send out to everyone. And we wire money, you know, you get money for this and the backup servicer gets that. And here's your portion of interest income. And all of that requires someone in our office, in our finance department, to put all that together and actually go through that process. Every bit of that could be executed with smart contracts. Most of you know this, but for those that don't, smart contracts are not really contracts. They're really a set of instructions, of actions for the system to take automatically based on certain trigger events without human intervention required. So we don't have to have somebody put all of that together. The system can automatically do that on our behalf. Another use of smart contracts that I think is really takes full advantage also of blockchain's feature of an authenticated digital immutable timestamp is servicing, loan servicing on chain. If we can record a customer's car payment on chain and immediately through smart contracts, upload that information to the credit bureaus, we provide a way for that person to have a much more robust representation and real-time, more accurate representation of who they are and their financial picture. It also saves us a lot of effort because this process, if you have never done it before, is a monthly download of our portfolio and all the payment history and activity that has occurred, and an upload to all the credit bureaus, and then they audit and approve and review. And hence the comment that I made about credit being a lagging indicator. The data is stale. We're talking 3 to 4 months of data lagging behind before it's really reflected in a credit score. And that's important for a population that is seeking to build their reputation and their sense of trustworthiness and creditworthiness in the market. And they do that through our company. We're like the second chance factory. We de-risk risky borrowers, and then we send them off once they've paid off their loan and they're 200 points better on their credit score to a more traditional lender down the road. These incontrovertible timestamps that come into transactions through blockchain provide a way of really documenting and cementing the view that this person really is a much better credit risk than perhaps what their credit report actually says. Chris may have more input on this than I do, but I don't think that there are any lenders currently making car loans on blockchain. I do think that there are some mortgage companies that are beginning to use it. And I know that there are companies out there that could utilize the loan origination systems that they're building for blockchain that might be able to take that and modify it for our use. There are a lot of big companies out there that are investing tremendous time and resources and energy and money into blockchain, you know, Toyota and Ford and General Motors and BMW and many, many others. And how absolutely cool would it be for a little bitty company like On the Road Lending to beat Toyota to the punch and actually get this done ourselves first, which I would absolutely think would be wonderful. We would really like to get this done. Beyond lending in our realm and the way that we currently do it, there are a lot of other opportunities out there for us for On the Road Lending's future version and our other companies. We could make loans in emerging markets for mobility, for tuk-tuks or rickshaws or taxis or tractors using blockchain and coordinate payments across borders without SWIFT banks and intermediary financial institutions. We could help our clients to make payments using cryptocurrency, digital currency. We could securitize portfolio of loans and do all of the capital raising using digital currency. Through our green bond issuance that we're getting ready to do, we have to track metrics around environmental outcomes and social outcomes, and all of that could be done on chain and reported. Through On the Road Garage, our collision facility, I'm very intrigued with the idea of combining advanced driver assistance systems that are on most modern cars. You all probably have that on every one of the cars that you drive, that are lane keeping or tell you if there's a car coming near you, or a variety of things that is put on the car now, cameras and sensors, to help to prevent accidents and keep people safe. If we combine the ADAS systems that we calibrate here in On the Road Garage with in-vehicle telematics that all of our cars at On the Road Lending have, with blockchain, we could get real-time information about events that occur. Instead of an estimator, human being, looking at a car and saying, okay, here's where the damage is, the car can record it itself, and it can be recorded on blockchain and handled in real time. And the estimate can be done with much greater accuracy and much greater attention to safety, and can automatically be sent to the collision facility, and those parts can be ordered immediately, and the process gets sped up and done better and more efficiently, and better for the consumer and the insurance company and the facility. I think there's tremendous opportunity for us to do that. We think that there is a great opportunity for vehicle DNA and the entire life cycle of a car, from birth to death, the raw materials that go into the manufacture of the vehicle and all of its component parts, all of the events during the car's life cycle, in the accidents and changes of ownership and maintenance records. It's like a Carfax on steroids. And it could record the death of the vehicle. What happens to those component parts when the car gets to the end of its economic useful life? Do they get recycled? Do they get tossed into a landfill? What happens there? And as we inch closer to autonomous vehicles, I think that there are real opportunities for blockchain and for smart transportation systems, for cars to communicate with each other, to communicate with its surroundings, and provide really important, useful data that can be permanently recorded on blockchain. So as I said at the outset, to me, blockchain is all about trust, and financial institutions are all about trust. And so it seems that there's a natural marriage here. And for On the Road Lending and all of our other entities that are really interested in bringing down the cost of transportation across the value chain, any incremental benefit that we can get, any greater efficiencies or opportunities to reduce friction, remove the middleman, and get that level of trust down to this consumer who is credit invisible or credit challenged, through a reputation index and all these other ideas. We think that there is a real terrific fit for us, and we're very eager to be at the forefront and one of the first small companies to adopt blockchain in its operations. Thank you.
Great, thanks, thanks, Michelle. That was wonderful. So wow, there's so much that I sort of want to riff on that, but I don't want to take the time, because I know there's going to be lots of questions and comments. But let me just mention three things. One is, I'm so glad you brought up accounting. I want to actually even take it back further. If you and you went back to the 1490s and Pacioli, but let me take it back another 6,000 years before that, to the clay tablets of Mesopotamia and the Indus Valley. That is where accounting started, but it's also where modern math started, right? It was those symbols on tablets that allowed for the king to, or the king to account for tithes and taxes and property records that allowed the development of mathematics and social organization. You couldn't organize society. And if you plot, it's really interesting. If you plot global GDP, and you can actually do this through estimation back, 100,000 years into hunter-gatherers, it basically is flat until you hit that point of 4,000 BC. When you had that math and social organization, and then the growth rate doubles, and you take that growth rate right to Pacioli, and you go move from single entry accounting to double entry accounting, which suddenly enabled bankers to finance businesses and enabled an expansion of trade. But it also enabled something else. Accounting required something new. Which was zero until Pacioli. You didn't really use zeros in European mathematics. The Arabic world had it, but not the Europeans. So suddenly you needed zero because double entry requires things to sum to zero. And so they introduced zero. And of course, accountants were in great demand because they were the foundation of this new banking and trade. And so schools began teaching the mathematics with zero. And you can trace that directly to Newton and the calculus, because you have to have zero to do calculus, and the limit as you approach zero.
So Chris, you and I need to sit down and have a conversation about this. We can geek out all day long on this topic.
Okay, that would be fun. I look forward to that. But you can trace the calculus then to engineering, the Enlightenment, and that, of course, led to another doubling of world GDP. And it really just looks like a hockey stick with those innovations in accounting. Correlation and causation, who knows? But it's extremely interesting. And so you bring it now to today in blockchain and triple entry accounting. I think there is the potential now for that to be a huge contributor to human well-being and another doubling of the growth rate of GDP over some period of time. So that's number one. Number two was, I'm so glad you brought up smart contracts. I'm going to do a little history lesson on that as well. The original paper on smart contracts was written in, I believe it was 1994, so 15 years pre-Bitcoin. It's an essential related technology to crypto and blockchain, by a guy named Nick Szabo, who many people think is Nakamoto, but that's an aside. Anyway, Szabo's 1994 paper on smart contracts used two examples of things, and one was auto finance, a leased car that suddenly locks itself up if the lease payment isn't made. So that's just another little bit of interesting history. And the final thing I wanted to comment on was sort of this reputation index. Many of the MOBI participants know, but probably those outside of MOBI don't know. MOBI is building an infrastructure for our members to build applications. And one part of that infrastructure is a network, variously called MOBInet or the Integrated Trust Network. But the core of that is a schema for identities and verified credentials. So the ability to link reputation to identity in a trusted way that doesn't give up personal identifiable information. It can help with that KYC and all that stuff. And so MOBI is building that, and we look forward to some announcements around that coming out before the end of the year. So great, thank you for all of that. And I'm going to turn it over now to Kelly, and hopefully we have some questions and comments from the community.
Yeah, thank you both so much for a really fascinating conversation. And just as a reminder to everyone, please send your questions to everyone in the chat, and then we can go through those. So we can get started. First question is, does on-the-road lending leverage or consider one's crypto asset holding when making lending decisions? If so, does that information get placed on chain?
So no, I don't believe that any of our clients actually possess any crypto assets, but if they did, we certainly would look at that. We're interested in understanding the financial picture of the people that we're making loans to, and so we certainly would.
Okay, great. Any other questions? Please send them just in the chat here. Someone says MobiNet is a MOBI must. Great.
We'll have to do a community lecture on MobiNet after we make that next announcement.
Definitely. Someone asked, how would a blockchain leverage its features on an autonomous vehicle?
So I think that for autonomous vehicles, the ability to use the telematics information that is generated by the car itself, it can be communicated on chain to record any events and activities that occur, would be one thing that would potentially be able to be used. I also think that advanced driver assistance systems is a progression on the continuum for autonomous vehicles. There's different degrees of autonomy, and those cameras and sensors that are built onto vehicles today, I think that that information getting recorded on chain will help a lot with the progression towards autonomous vehicles.
So I think we could probably do a whole hour on that question. But maybe I could take a minute or two, because that's kind of one of the things that got me interested in this technology and vehicles and mobility services. First of all, remember that what blockchain is one of the things blockchain is doing, or it enables, is the ability to give an identity to anything, right? A person, a company, a connected device, a smartphone, a vehicle. So anything can have an identity and can transact with other things and become part of an IoT economy, right? The economy of things. Now, we in MOBI coined the term the new economy of movement to characterize what we think is the coming multi-trillion-dollar ecosystem, economic ecosystem around connected devices, transacting with other things directly, infrastructure, roads, other vehicles. Now, with respect to autonomy, we're actually seeing applications already with blockchain identities and connected autonomy. Maybe the first thing to mention is this ability to have identities creates a new type of autonomy. The autonomy that most of us are familiar with is the autonomy that developed out of the DARPA Grand Challenge in 2004, 2005. And what that autonomy was put a bunch of sensors and compute power on a vehicle on board and have that vehicle act like a person, i.e. a self-contained smart unit to navigate. Those vehicles were not communicating with other vehicles. They were not triangulating using sensors that were in other vehicles. They were not using any benefit from information that other entities were collecting. But that kind of autonomy turned out to be very, very difficult. And that's why, autonomy always seems to sort of full level 5 autonomy always seems to be 3 years in the future, right? And the joke is, it always will be. I don't think that's true. I think we'll get there. But it is this self-contained autonomy is the world's hardest AI problem. It's the mother of all AI problems. And that's why we're not there yet. Connected autonomy, coordinated autonomy is much more interesting, right? Because you can bring real-time maps developed by cars in front of you, right? To bear on your driving. You can take information around the corner from where your sensors can't see, or a bump that's in front of the truck that's in front of you that your sensors can't see. More importantly, you can make slight adjustments to your path or speed to really improve the throughput in a city. Two cars approaching the intersection at the same time. Communicating, one can agree to slow down slightly, the other can agree to speed up slightly, and they can breeze through very close, very efficiently. And the early tests of this suggest that you might be able to increase the throughput in a given city footprint, infrastructure footprint, by 5 to 10 times with coordinated autonomy. The final thing I mentioned with coordinated autonomy is a bunch of tests have been done by some big truck companies, big truck manufacturers, with platooning where each truck has a ID. Each truck has information about how much it weighs, which is important because that determines how safely you can draft the truck in front of you. Drafting saves money, but it's a burden to the truck in front that's doing the work. And so the blockchain systems not only allowed for real identities, transactions, information about the weight of the trucks and the safety, but allow the payment to the truck that's leading and bearing the economic cost. So a whole lot of stuff on autonomy. Be a great subject for a future lecture. Great question.
Thank you very much. Thank you, Michelle. Thank you, Chris.
Thanks. Our next question is how many lenders? I think it's asking how many lenders you serve at On the Run Lending.
How many lenders? So we are the lender. We have a lot of investors who are part of our organization, but we're the lender ourselves. We make the loans and have the lien on the vehicles. And I'd say we've got, I don't know, maybe 20 impact investors that are part of our fund and maybe 10 banks that are a part of working with us.
Great. Next question is, how do you handle the real-time credit reporting with recallable payments, where the report of a payment having been made might go through before the payment is canceled or recalled?
I think it would end up being just recording a subsequent transaction, very much like accounting.
And our next question, how many references are needed for a reliable character or reputation score?
That's a really excellent question. We have some limitations on what we can do just because of time. So we generally limit it to about 3. And we try to make those be ones that we think will be the most impactful.
Great. And how would you handle false positive automated damage reports? And additional information, i.e. would an imperfect sensor false positive damage report placed on chain in real time reduce the vehicle value and cause a financial obligation for payment for replacement parts?
Yeah, that's a really good question. And I'm not sure that I know the answer to it from a collision perspective. You know, I think I could see where there would be the possibility of ordering parts in advance for something that ultimately didn't end up, a repair that ultimately didn't end up getting made. But in that case, I think that the parts would just likely be just returned. As far as a diminishing value, I think it'd have to be a pretty severe misapplication of an accident for it to result in, you know, a little tiny sensor saying that there was a fender bender when there wasn't one. I don't think is going to have a significant impact on value.
Next question is, I like the idea about automatically reporting vehicle crashes with immutable records. I think that NHTCA is contemplating some requirements for ADAS vehicles in the future, and this would make compliance frictionless.
Yeah, yes. So the whole point of ADAS really, I mean, it is part of an effort on the quest for autonomy, but it is also at the lower levels, at level 1 or level 2 of autonomy. It's about keeping people safe. And the reality from our perspective is that there is a substantially higher risk of accident, incident of accidents for lower income people than there are for higher income people. And part of the reason is that those vehicles do not have as much ADAS on them as the newer cars do. And we all know from getting stuck in accidents that it has a huge impact on the flow of commerce and our ability to move around. It impedes mobility. And so anything that can be done to reduce friction and to improve the performance of a car and reduce the likelihood of accidents, I think is a benefit for everybody. Can see why the Transportation Safety and Department would be working on that.
Great. I think we have time for a few more questions if anyone wants to put any more in the chat. We have, what about privacy implications?
Great question. So one of the things that's really terrific about blockchain, and Chris can talk about this more than me, is the ability to create a digital identity that doesn't disclose personal information. You want to talk about that a little bit, Chris?
Yeah, thanks. It's obviously something that the blockchain community thinks a lot about. Michael Casey, who's a former Wall Street Journal reporter and wrote many books on blockchain, is now the chief content officer for CoinDesk, coined a great term about that, which was that blockchain and this technology has the ability to fix the original sin of the internet. And he was referring to the fact that on the internet, everything is exposed. If you do a transaction, you have to send not only your credit card information, but sort of all of your identity up to the banking system, and it goes through many hands, and it's collected then at potentially at many points, each of which is a honeypot, because you're not only collecting your data, but you're collecting everybody else's. And so we see the result in no online privacy, in an enormous attraction of cybercrime and hacking and bad actors attracted to those honeypots. And also this problem of identity not being secured, right? It's the most famous cartoon in the history of the New Yorker magazine, which is famous for its cartoons, is that one about the two dogs sitting in front of the computer. Everybody knows this cartoon. Two dogs in front of a computer screen, and one is saying to the other, the great thing about the internet is nobody knows you're a dog. Privacy and identity is the root problem, is the original sin of the internet. And blockchain, by creating secure identities and linking information to that through verified credentials, is a wonderful approach to privacy. We are building it into MOBInet, or this integrated trust network, ITN. The core of the ITN is shared identity, being able to put identity on there and have it done in a way that can be shared in wider communities or with other consortiums, and with other networks, while keeping the personal information permissioned. And as a practical matter, the way it works is your personal information is kept on the device, whether the device is a car or a phone or whatever, but it can be checked for the purposes of a transaction without all of your information going to somebody else's, through the scraping of the data into somebody else's database. And if you think about what the next step is in mobility, really the holy grail is multimodal transit. And you ask, everybody's been talking about multimodal transit, this idea that the ideal trip, the useful trip, might begin with a short walk to a bus station, a bus ride, a subway, and a short Uber or scooter at the end. What everybody would want is the ability to go into a map based app, construct a trip with a push of the button, by inputting the destination, and then have that trip, arranged for them, without having to pay, for all four legs independently, without having to enter their data for all four legs independently. So seamless multimodal transit that gives the same experience that we're used to on the internet, big platforms, where there's a big aggregator providing those services, those aggregation and integration services. All of that is what we want for the customer experience, but we can't do it without sharing our information in ways that are problematic. And so what MOBInet and others who are active in the Web3 space are working on is being able to enable that, where the information goes through, but is never subject to scraping and aggregation by a potential data monopolist. So I think that is, and doing it in a way that's compliant with the EU directive and the California privacy rules and the emerging standards around privacy and online transactions. So that's where this is all going. It's a great question. Expect to hear more on that from us.
Great, thanks.
Yeah, and if I could just take 2 minutes to add on to that, I think the Holy Grail and what we all really want is to be able to get around as efficiently as possible. And there was actually a funny little story in The Onion, the satire magazine, that said, 98% of Americans favor mass transit for someone else. They want everybody else to be on the bus, but they want to be in their car. And the reason is they want to get there as fast as they possibly can. And I think if whatever the solution is, if it provides a way for people to get around efficiently and productively, and have our ability to move around, work in the best way for all of us and the least expensive, is a good outcome.
Great. I think we just have one more comment question before we close out. So someone wants to know if you could please elaborate on how you report to the credit agencies.
Yeah, I think somebody wrote back that the traditional means, it is the way that most lenders do it. We have a system that they use, a credit manager system that all the credit bureaus use. We download our report on payments and it gets uploaded through that system to all of the bureaus. Most lenders use the same, it's called Metro 2 system.
Great. All right, well, thank you so much for your questions, everyone. And thank you so much, Michelle and Chris, for this great conversation. And as a reminder to everyone that joined us today, this lecture was recorded, so it'll be on our website if you want to share it or watch it again. We also have a lot of other exciting lectures coming up, so be sure to check those out. And thank you again, Michelle, for joining us. And have a good rest of your day, everyone.
Thank you.